Yep. Hello. Come on, it's Thanksgiving. Hello. Gobble, gobble. There we go, right there. Thank you. I have the privilege of welcoming you all to the third event of the Syndicate Room series focused on post-Brexit returns. As I look out and I see kind of 450, 500 people here, I can't help but hark back on our first event, wherever Gonzalo is, where we had maybe 40, 3 years ago, almost to the day. Oh, he's over there. Our first event where we had kind of 50 people there and thinking, wow, 50, this is amazing. And now we've got at least that many live streaming us on YouTube. The rest of the YouTube audience, 300, 400 million, are probably watching cat pictures and Justin Bieber, but I won't take that as an offense. Tonight we have some very special guests with us. I'll get into them in a little bit, but putting together something like this actually takes a lot of effort and a lot of time, and hopefully it looks that way. If not, blame Marcin. But there are a few key people that I wanted to say thank you to who have kind of helped us along this journey. And I think I have a slide. But the first of them is a company by the name of BDO, and in particular a guy by the name of Gary Hansen and his team. Now, BDO are one of the largest and best accountancy firms and business service providers out there. Gary actually knew about Syndicate Room before I did, and I'm a co-founder, so that says a lot. And he's been with us for a very long time, helping us along the way. He was great in providing the facilities for our last two events, so for anyone who came to the first two in the series, he put that all on. It was at his place. Everyone got free drinks. Unfortunately, Gary isn't here tonight, and I finally brought him the bottle of wine that I've been promising him for a year. But in true entrepreneurship fashion, I'm just going to offer it to our next guest and pretend it was for them in the first place. So next on the list of people that I have to say thank you to is actually a group. Now, when we first started up and we were a startup, we used to go into meetings and we used to tell people all these wonderful figures about how big the marketplace was and how much we were going to grow. And we'd pretty much make them up, putting a finger in the air and saying, yep, it's going to be a hockey stick, and in 10 years' time, we're going to be worth this. Now, we pay people to make up those numbers. So to FTI and to Bowhurst, who put together the wonderful reports on Growth Hunters, which you'll all be getting a copy of later on, thank you massively for all the hours that you've spent doing that for us. The statistics in it are exactly how we told you we wanted them to be, so it's great news. They make us look incredibly good, and we will definitely use you again. Next on the list is a group, is two groups who have actually given us columns in their papers and on their website. They've given us space at their events. They've been promoting us to their networks, and they haven't charged us a lot for it. So massive thank you, and actually they've done a lot of it for free, to City AM and to Master Investor. They've been super kind with their time for the last couple of years, and we wouldn't have wanted better partners. Particularly because we used to put their logo on our website, and we just prayed that they wouldn't call us to take them down. And now we can officially say, hey, they are our partners, so that's obviously good news. And last on the list of people that I want to thank is actually new to the Syndicate Room partner network, if you will. It's a group by the name of London Southeast, lse.co.uk. You've probably heard of it. They provide financial services, information, and trading functionality to over 1 million people every month. They believe in the same things that we do in education and integrity and transparency. And I do hope, and Scott and Phil and Steffi and Paul and Terry, if you're watching on the live stream, that this is the first event that we do with you where we come together and we collaborate on it. So thank you to all those people out there. A little bit about Syndicate Room, because we're paying for the stage, so I get to do this. We have been going for 3 years, and last week we actually completed or participated in our 100th funding round. So to go from me and Gonzalo in this shared office where we would take as much free biscuits and free coffee as we could, to a company that's supported over 100 businesses who still takes as much free coffee and biscuits as we can wherever we go because we're that way. It's been an incredible journey, and none of that would be possible without the team at Syndicate Room. We've gone from 2 to about 30 people. We have a number of people who've been working the last 3 weeks, pretty much nonstop, to deliver the new products, which we'll be talking to you about, to deliver the report that we'll be talking to you about, and to, of course, put this event together. So if I could ask for a quick round of applause for the Syndicate Room team and all of our sponsors. Thank you. Tonight, it is about growth. It's about growth companies. It's about growth stocks, growth investing. And if you add all those up, it's more G's than you get from Virgin Media. I have thrown a bad joke. It's just the way I do it. I know you're probably tired of hearing me speak, but before the next speaker comes up, I have to say that the gentleman who will be speaking, Mr. Jim Mellon, is not associated with Syndicate Room, and the opinions that he gives are his own and should not be construed as advice from Syndicate Room. With that risk warning, and the last one that I have to get out, if there's a fire, the exits are here, 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 and here, and the closest one may be behind you, so make sure you look behind you. There is no fire drill planned, so if you do hear something, please do, as British people do, form an orderly queue and walk out. I'll be the American who pushes you out of the way. And with that out of the way, I'm going to turn it over to Mr. Jim Mellon, who's, he didn't want me to say this, but the master investor, and apologies for that. So Jim, please.
Thanks, Tom. Thank you. Thank you. Good evening, ladies and gentlemen. Thank you very much, Syndicate Room, Tom, Gonzalo, James, etc., for having me here tonight. And thank you all for coming out on a Thursday night and listening to a sort of rant from an investment guy like me. I've been learning by watching Donald Trump and Nigel Farage make their speeches about how to do some serious ranting. So I'll try and restrain myself tonight, but if I get into far off territory, I've been sort of overdosing on the right-wing triumph in the US and in Brexit here in the UK. I love Syndicate Room. It's a really fantastic platform. I think it's going to grow and provide fabulous opportunities to British investors. I have not been paid for this speech, although apparently I'm going to get a bottle of wine, I just heard, which I will definitely be claiming on the way out. And I think that we have in the UK something that is unique, actually, in the world that I know of anyway, which is the EIS and SEIS schemes, where you can get tax relief on investment. I don't think it occurs anywhere else. And their new fund, which is, I understand, called Fund 28, even though it's the first fund, looks pretty good to me. And so I would recommend you stay on after my rant and listen to their presentation on that, which is probably going to make you some better money than I'm going to make you. Today I'm going to speak about the macro outlook. And I was at Farage's party last night, sort of hiding in the shadows. And you probably saw the big heap of Ferrero Rocher chocolates, portraying him as a potential ambassador to the United States that he was handing around. But he did say at that party that this was a year of complete upset and revolution almost. And I think that's true, and there's more to come. And as investors, we've got to be extremely aware of what the pitfalls and opportunities are from that tumult that has occurred and is going to occur. And it's a fact that had you been brave on the day of Brexit and bought as the markets plummeted around the world, and invariably it's the Asian markets that open first, and invariably the Asians who panic and sell, that you would have made very, very good money, even if you didn't believe in Brexit or Brexit was going to happen. And the stock markets are at record highs in the UK. And the same with Donald Trump. I was on the boat going to New York when the election results came through, and my colleague and Anthony and I were tweeting across the airways because the US market opened down the record amount, or the maximum amount that it's allowed to fall in one day, and then before you know it, we're again at new highs. So use the opportunity of panic always to at least think about it as a buying opportunity as opposed to a selling opportunity. That doesn't mean to say that I think the UK market and US markets are worth buying at this stage, and I'm going to talk about why, and particularly in the case of the US, I don't think that's the case in a second. But these periods of tumult give us great opportunities. And the next one that's coming up, which I'll talk about, is, as you all know, the Italian referendum on December the 4th. And it's the first of a series of potential fuses in Europe that can cause both terrible markets and also opportunities for savvy investors who are prepared to come out on a Thursday night and listen to perorations such as mine. So the macro outlook is, mixed, I think. And, but it is Thanksgiving, and after this, I'm running off to my pub, which is reopening, and we're having a little Thanksgiving ceremony over there. And President-elect Donald Trump so far hasn't been as bad as people might have suggested before he was elected. And I was in New York on the week that he was elected, and outside my hotel room were 10,000 at least angry demonstrators all going on about we have no respect for our president-elect. I think that crowd is now dissipated, and people are kind of getting used to the idea that he's going to be the president. And generally speaking, the economic policies that he espouses, with the exception of protectionism, which I'll talk about in a second, are not too bad. However, one has to be a little bit worried about the potential for geopolitical conflict, given that he's an untried person on the foreign stage, is known to have a kind of impulsive temper, and he's also going to have access, unlimited access, to the nuclear button. So as you know, in his previous career, he was in charge of these celebrity and apprentice shows in the United States, and his signature phrase was, "You're fired." Well, what we hope is that he isn't going to say it to America's nuclear missiles. Otherwise, yes. So that's the big danger with Donald, but I'm hoping and praying that that's not going to occur. So as far as the economics are concerned, Trump has good aspects and bad aspects. And I think from an economic point of view, and you can see it reflected in the stock markets and in the bond markets, there are several features that we have to recognize as investors that represent the end of the growth deflationary period that occurred when Ronald Reagan came to power in January 1981, which was 36 years ago. First of all, Trump is a Keynesian. He's not a Friedrich Hayek or a Milton Friedman type of guy, and doesn't really believe in monetary restraint. And I suppose that comes from the fact that he's worked his way up through massive leverage through his real estate career, so probably that's the way that he thinks. He's also a great believer in the Laffer curve, which has its adherents, and I think there is something to the Laffer curve, which, as you know, means that if you cut taxes, you actually increase economic growth, and thereby you improve tax revenues in the long run. And so we are going to see in the United States, and I know this to be the case, we're going to see income taxes, particularly for people in the middle, which is about $70,000 to $100,000 US dollars a year, cut. The tax code simplifies, which has got to be a very good thing, and I hope one day we'll do that in this country as well. And corporation tax will be cut from the current headline rate of 35% down to 20% or possibly below that. In addition, there is a large amount of money in the US that is held offshore, $2.6 trillion. It's held offshore by American companies that don't want to repatriate it, have made the profits overseas. Apple, Google, Facebook are good examples of that, but also large US pharmaceutical companies, and that money sits in Singapore and Luxembourg or whatever, waiting for an amnesty to bring it back to the United States. And when they bring that back, they typically get a clip of, and I think Donald Trump will probably charge them 10% to bring that money back. But $2.6 trillion is a lot of money. And when the last amnesty occurred in 2004, most of the money sitting offshore came back, and it was almost all invested in share buybacks. And so one of the reasons that you're seeing this rise in the US stock market, and I'm going to talk about that in a little bit more detail in a second, is because people anticipate this repatriation, they anticipate the lower corporation tax, they anticipate a reduction in capital gains tax in the United States, and they think that this is all jolly good news. But the jolly good news doesn't outweigh the fact that there are some negatives in the US, the most important one of which is that the stock markets are too high. And I'm going to talk about that in a second. Now, we do have the issue of trade. Is Donald Trump going to, first of all, be protectionist not only against immigrants and build that wall along Mexico's border? Well, there is already a wall, and I think there will be a sort of token extension of that wall, but fundamentally there are more Mexicans leaving the United States than coming to the United States these days. So it's not really a big issue. There is a big issue with the trade deficit with China. It's running at about $400 billion US dollars a year, and I think what will happen is there'll be some backroom talk about slapping some punitive tariffs on a few products, but there won't be a retaliation, because Trump and his advisors recognize that doing what was done in the 1930s, which was the introduction of the so-called Smoot-Hawley Tariff Act, where Americans racked up huge protectionist barriers against imported goods, and as a result, their depression went on much longer than the European depression did, and went on for 7 years, is not a good move. That trade is vital to the world economy, that we should do everything we should to encourage it. So even though he's cancelled the TTTP and there won't be a trade deal with Europe, we still, and United States still operates under WTO rules, and they're perfectly satisfactory, and we, in the UK, have operated with the United States under WTO rules as far as trade with the US is concerned for many years, and it's been a successful two-way flow. So I wouldn't get too worried about the trade issues as far as Donald Trump is concerned. And the Republican Congress is not quite as protectionist and on the fringes of economic lunacy in terms of trade as Donald Trump pretends that he is. And I think, in particular, Paul Ryan will be a moderating influence. So overall, the situation in the US doesn't look too bad. So what we're going to get in the United States is about a 2.5% growth rate next year and 2.5% growth rate following year. But the price of that growth, because of the increased borrowing that he's going to take on because he wants to improve America's infrastructure, and any of you who've been to New York or anywhere in the US know that the bridges and roads are in terrible condition and need repair urgently. The airports are in a shocking condition, and the general infrastructure is dreadful for an economy of that size and that importance. So he is going to spend money on infrastructure, and as a result of all those fiscal policies and infrastructure spending, interest rates are rising, and they're going to carry on rising, in my opinion, because we have now turned the interest rate cycle. We're moving from deflationary growth, as I said, into an inflationary period. And so you'll get inflation in the United States rising possibly to 4% by 2018, and that has big implications for investors in the way that we look at what we should invest in. So on the one hand, you have stronger economic growth. On the other hand, in an era of full employment, or just about full employment in the United States, and some very large structural pressures, you're also going to have, for the first time for a long time, proper inflation emerging. And that inflation and those interest rate rises, by the way, will translate to the rest of the world as well. So Donald Trump's victory is something that appears to be sort of a populist movement that's sweeping the world. And some people say, well, it's angry white middle class phenomenon across both Europe and in the United States. And actually, I think it's a bigger thing than that. It's not across gender or racial or ethnic lines. This is something that is a deep-seated frustration in the population that hasn't benefited from quantitative easing, from the easy money, zero interest rate policies that have been espoused by the terrible central bankers that we suffer from in the world and have suffered from since the year 2008, who have done more to destroy economic growth and productivity than really anything else in the history of economics. That angry section of the population is looking at really the following statistic, which is that had you put your money into the S&P in 1980, so $1 invested in the S&P index, just the index accumulated over 36 years since 1980, your $1 today in inflation-adjusted terms, not in nominal terms, would be $131. $1 invested in the average American median wage in 1980, that's the wage that, again, inflation-adjusted, that the average American gets, would be worth $1 today. So a small section of the population gets that $131, and almost everyone else gets the $1. So for 36 years, there's been no improvement in the standard of living of the general US population. And you can understand why across all ethnicities, all races, and both genders, that you are getting, sorry, it's 3 genders these days, isn't it? You are getting this, this frustration manifested in the election of Donald Trump, which no one would have forecast just a year ago. And it's because of this tremendous inequality that has been accelerated, accentuated by the zero interest rate policies of the central bank. To begin with, quantitative easing was a good thing. We needed rescue from the follies of the banks and the over-leverage of the banks and the stupidity of the housing market in the United States in particular. But that needed to be wound down very quickly. And we are still suffering from it in the UK to a certain extent, and in Europe they are massively massively suffering from it, and I'm going to get onto that because the big fault line in the world economy today is Europe. And I have said, and I talked about this at the Master Investor Show, that I expect that the euro has between 1 and 5 years of life, and it might even be less than that, because there's a very major event coming up on December the 4th, which you're familiar with. Europe is lurching from one crisis to crisis. Europe has a banking system that's only half fixed. Ours in this country is about 90% fixed. The banking system in the US is indeed completely fixed. And Europe's debts, in the southern part of Europe at least, keep on rising. It has a very dysfunctional trade situation where Germany is basically so productive that it outtrades most of the other countries, and there are serious deficits building up all the way across Europe. And this is manifested in the rise of the populist and nationalist movements, and we're all familiar with the various elections that are coming up in Europe in the next year, but the most important one is the Italian referendum occurring on December the 4th, because win or lose, I think that Italy is going to move to leave the Eurozone, which is the really root problem for the European Union at some stage in the relatively near future. And if you are a follower of bond markets, you will know that the Italian bond yields have gone up very dramatically versus German bonds, even though there is apparently a universal guarantee by the ECB that should equalize all bond yields all across the European Eurozone countries, 18 of them in the European Union. And that guarantee obviously is worthless if Italy was to leave the Eurozone. The fact is, like in several other countries, Italy suffers from no growth. Its industrial production has not grown since 1994. Its economic GNP has not grown since 1998. It has 40% plus youth unemployment. And by youth, I mean people up to the age of 34, which I don't really regard as youths, but that's an entire, utterly wasted generation. And those who have left Italy are generally speaking making coffee in Pret-a-Manger or in Starbucks in London or in Berlin or whatever. So it's an absolute tragedy for Italy, and it's directly the result of the imposition of a common currency on disparate countries with different cultures, different ways of doing business, and different economic needs far too early. It should have been phased in over a 50-year period, and instead it was hurried through, and now we have the result of a huge, huge mounting crisis in the European Union directly as a result of that, with the first manifestation being Greece. They managed to rescue Greece. It was a $350 billion dollar and extend and pretend type of situation. They can't do it for Italy, and they can't do it for France. And of course, the Germans are not inclined to do it anyway, because they have a very, very hawkish finance minister who doesn't believe in the monetization of the fiscal ineptitude of the southern European countries, but was a big proponent of the imposition of the euro in the first place. Now, in the old days, France, Italy, Spain, Portugal, and so forth could just devalue their currencies if they became uncompetitive, and it worked. And Italy had a tremendous period of economic growth. It's not a country where the people are feckless or uneducated or don't work. Sure, it's got corruption issues. Sure, it's got governance issues. But that's not the reason why Italy is in such dire straits. It's not the reason why Spain's in a terrible situation. It's not the reason why France is in a situation it is in. I loved it when the Remainers were all going on about we want to stay in the European Union for the sake of our youth. Well, what about the youths of Southern Europe? Where is their hope? Why do you want our country to have a similar youth unemployment to the one that persists down in Southern Europe? And until the euro breaks up, and it will, by the way, it's toast, T-O-A-S-T, until it breaks up, that situation will persist. Zero growth, zero productivity growth, despair, high unemployment, and rising government debts, which are so large in the case of Italy that they can never, ever be repaid. And furthermore, something called Target 2, which is basically where the Germans have an open overdraft at the Bundesbank, the Southern Europeans buy German goods, and at the moment, Germany is owed 800 billion euros by Southern European countries, which they will never, ever, ever be repaid. So basically, it's a way in which Germans get full employment making BMWs, sell them for worthless bits of paper down to the Southern European countries, and they'll never be paid back. So it's a bit like me as a bank lending money. hire purchase on a car, knowing that I'm never, ever going to be repaid. So it's a pretty bad situation in Europe, and it's only getting worse. Every year the ECB comes out with growth projections which never materialize. There's the occasional dead cat bounce. The euro's recent decline against the US dollar to 105 today isn't doing a lot to help exports. And this is the target 2 imbalance that I mentioned earlier. It's going up to record levels. The only way out is for a breakup of the euro. Now, the problem that if the euro breaks up, what happens to the banking system in Europe? In many cases, the banks are already bankrupt or notionally bankrupt, and that includes the German banks. But on the day that the euro breaks up, and they claim that there's no plan for Brexit in the UK, which is probably true, but there's certainly no plan, as far as I can see, in the European Union for one of the members of the Eurozone to leave the Eurozone. And on the day that that happens, and it will probably be preemptive, it'll probably be the Italians just saying, right, we're off, we're introducing the new lira, the whole of the European banking system collapses. The whole of the European banking system collapses because the German banks hold Italian paper, the French banks hold Spanish paper, and vice versa. All the capital of all the banks are wiped out. So what you can expect to see is some form of bank nationalization in Europe, and probably all the depositors in European banks will be forced to be bailed in to a certain extent, where they have to hand over a percentage of their deposits in return for shares in new banks, which presumably at some point in the future will be worthwhile. But bear this in mind, that the euro is going down. It's an unsustainable currency. There is no way that even the Germans, even if they wanted to, could keep it going, and that is the biggest fault line that we have. So on December the 4th, there is an election in Italy, a referendum as to whether the Senate should be reduced in size from 300 odd down to 100 and make Italy a bit more governable. And it looks, although opinion polls have been very wrong this year, that Italy is going to vote against that, and then Mario Renzi will presumably, he said he's going to resign, and he'll resign. And then the Five Star Movement, whose party motto, and I'm not going to actually specify what the word is, but it begins with an F and ends with a K, FK off. That's their party motto. That's not like, even Donald Trump wouldn't use that. Is going to come to power, and their whole leitmotif, a bit like Nigel Farage's party, is basically to leave the European Union, and to, in particular, to leave the euro. And I'm a big fan of the European Union. I certainly wouldn't have been a pro-Brexit guy if there wasn't the Eurozone. It's the Eurozone that was the federalist move too far. There are many other aspects of Europe which I applaud. I applaud open immigration, unlike some of my fellow Brexiteers. And I applaud common regulation. I think it makes a lot of sense in many cases. And I think that, despite follies like the CAP, there are a lot of good things that Europe does. But the reason I was for Brexit is because I can see this economic car crash coming, and that car crash is going to affect us all. Now, how it affects us as investors sitting here in the UK, where we have our own currency, which has been a wonderful shock absorber for the Brexit vote, and for other times as well, I don't really know, but I do know that what will happen is everything will gap down on the day that this happens, and then there'll be an opportunity for us to look at buying. So one of my rules of investment I'm going to talk about is to always have some cash, or at least have the option of cash, because it provides the optionality of making money in a crisis. And so just keep some powder dry at all times to be used in these tumultuous times, and times of great opportunity as well as disaster for others. So as far as the UK is concerned, we don't really know what the shape of Brexit is, but I suspect that our Brexit plans, if there are any, are going to be overtaken by the events in Europe. And so it could be that in a year's time we're looking at no invocation of Article 50, because Europe itself has had such major problems that it's in the process of some deep structural reform. And in those circumstances, maybe we want to stay in rather than go out. Our exposure to a foundering Europe is fairly substantial, but our banks are not exposed, or they're very lightly exposed. And so I wouldn't worry about our banking system. But what I would say is that we are a very unusual country in terms of our currency, because we are the largest, believe it or not, foreign investor in the rest of the world. We have over £7 trillion worth of foreign investments. there is also £7 trillion of foreigners' money invested in the UK, a large part of which is in the gilt market. And when the pound falls, the translation effect of the foreign income into our country has a very fast auto-correcting mechanism for reducing our current account deficit. So the pound was overvalued pre-Brexit. I think most people would agree with that. It's probably undervalued today, and I can tell you now that last year we had a 5% current account deficit as a percentage of GDP. In 2 years' time, we will have a surplus. And that's because of the very unusual situation where we have such big foreign income that's translated back into pounds at lower levels and therefore auto-corrects the deficit very quickly. Obviously, our FTSE 100 companies are benefiting enormously from the fall in the pound, and that's why their prices have gone up so much. But the 250 index, which is the domestic index, has also risen to basically record highs. It's kind of priced to perfection, I would say, at the moment. I mean, there are obviously opportunities, but I think you'll find more opportunities in the smaller growth stocks, such as the ones that Syndicate Room promote, and such as the ones where, if you can sift through the AIM market, London South East will be a great help in that respect, and of course, Master Investor. Then you can still do well and buy good quality companies with good management and buy them for growth. So as far as the UK is concerned, I'm not too worried, but we have to watch the continental developments because they're going to make Brexit look like a sideshow. And, so be ready with your cash. And so watch that. You all know about the trade relationships with Europe. We buy much more from them than they buy from us. And it's a very complex situation, but I really don't believe that we're going to end up with a trade war because, as I said, events are going to overtake our Brexit situation in Europe, and the Europeans will have other things on their minds than punishing Britain or trying to make us the example not to leave the European Union. But I don't know what sort of club it is where you join, and if you want to leave, you're punished for it. It sounds a bit like prison to me, but there we go. Now, just quickly going around the rest of the world, the emerging markets are not beneficiaries of a stronger dollar, and the dollar is strengthening because interest rates are going up in the United States. And they're not beneficiaries of that because they have a lot of dollar-denominated debt, so it's a bad thing for them when the dollar goes up. But they're not nearly as indebted as they were the last time that the dollar had a big rise, which was in the late 1990s. But China does have particular problems. It's got massive debts. But it also has a central government which can basically do what it wants. And so extend and pretend will carry on in China for a few more years. And I wouldn't be too concerned about the Chinese situation, although I wouldn't be a big investor in the Chinese markets at the moment. Now, and largely, the emerging markets are still commodity dependent. Either they're big consumers of commodities and very affected by the price rises or falls of commodities, and that would apply to China as an example, or Korea, or Japan, which is not an emerging market, obviously. But the other countries, are the Philippines, Thailand, and so forth, are quite commodity dependent in terms of getting prices up. And so, and Indonesia, of course. And so the commodity issues are very important to emerging markets. But overall, the emerging markets are not going to do as badly as they did in the late 1990s, and indeed some of them may be buys. And I would particularly highlight India, which has gone through some ructions recently with the change of currency. The 500 and 1,000 rupee notes exchange was badly handled, and it's probably going to bring Indian growth down very, very sharply. But it may provide an opportunity to invest in what is the world's fastest developing economy, and one which has absolutely tremendous and unlimited potential. So in summary, from a macro point of view, there's been huge misallocation of capital by governments using the QE, ZIRP, NIRP, and all the other zero interest rate policies and so forth. US equities, in my opinion, are overvalued. So in 1981, when Reagan came to power, US equities, at a time when earnings were going to go up, were selling at 8 times earnings. The US Treasury rate on 10-year bonds was 13%. And we were going into a deflationary growth period. All very, very positive stuff. Today, the US PE ratio is 26.6 on the cyclically adjusted PE ratio measure, Robert Shiller's measure. On some other measures, it may be 17 or 18 times. And even with the tax cuts that are coming and the repatriation, it doesn't look cheap. And at the same time, US earnings are under pressure because the strong dollar is pressuring those earnings. And because of full employment in the United States, wage rates are going up. So the margins which have expanded, the share of the economy taken by companies has been widening and widening, and the share taken by labor has been narrowing and narrowing, as I said earlier. That is now in reverse, and that's not a good sign for US stock markets. And I think the ones that are going to be particularly badly hit are the so-called FANGs, the Facebooks, Amazons, and the big sort of platform companies, Alphabet, formerly known as Google. They are wildly overvalued, and we would be short those companies at the moment. And they're also not beneficiaries of the tax issues in America to any great extent, because they don't pay much tax. So they fiddle their accounts by moving them to Luxembourg and Ireland and all that sort of stuff. And so I think that, and also they're subject to disruptive technology just as they were once disruptive technologies. And I would say that they are highly overvalued. But you might just like this fact that last year the platform companies around the world, internet platform companies, made $1 trillion in profit. That's a lot of money. And of that, 800 billion went to America, mostly California, and only 5% of it came to Europe. So that's how far behind we are in terms of technology companies. And I was glad to see that one unicorn has been monetized in the UK, which was Skyscanner, which was bought out today by a Chinese company. But we really have a pathetic technology industry compared to what we should have and what America has. And we're good. We're good compared to Germany and France and the rest of Europe. Quantitative easing, yeah, and the result of quantitative easing, I'm just going to very briefly touch on this, is what I call the bond fire of the vanities. Now, you may know that in recent weeks, bond prices have been plummeting around the world, and so they should. And the morons, and I mean certified morons of the ECB, and I don't know who else, no one in this room obviously, but institutions and a lot of Japanese investors were buying negative interest rate bonds this summer in large quantities. We're playing a pass the parcel game, because who is going to buy something at 100 that you're only going to get 95% back on in 10 or 20 or 30 or 40 or 50 years? So at the height of this mania, which is equivalent to the Dutch tulip mania, the Irish and Belgian governments each issued 100-year bonds. Now, as you're going to see in a second, I'm a believer in longevity. I think we're all going to live much longer lives than the Bible has prescribed for us. But who knows what's going to happen next year, let alone in 100 years' time. And morons were buying these 100-year bonds at 1 or 2% interest rates, when fundamentally they're probably worth pennies in the euro or pennies in the dollar. And so the idiots who bought these bonds just a few months ago are now sitting on losses of between 30 and 40%. And we're not talking about trivial amounts of money. All right, these are huge amounts of money. I applaud the Irish and the Belgians and the Austrians and the rest of them who issued these very long-dated bonds, the Italians even. The Italians have got a 70-year bond out there because that was the right thing to do. Lock in the money for as long as possible at the lowest possible interest rate. And we should have done that in this country. Maybe it's not too late to do it. Because fundamentally, governments can inflate their way and will inflate their way out of the valuations of these bonds. So, at some point in the future, the yields will be 10 or 20 or 30%, and whoever put their money in now will have very little left other than a certificate and regret. And that's what I don't want any of us to have. But that fundamental mania, driven by quantitative easing, is symptomatic of the appalling decisions made by central bankers around the world, which have caused this zero productivity growth, zero capital investment growth, zero income growth around the world, and have misallocated capital such that companies that such a Syndicate Room, as an example of promoting, just can't get the money that they deserve because the governments are crowding them out of the financial markets. That's coming to an end now. And I still think that bond yields, which have moved up a lot in recent weeks, are going to move up a lot more. We're in an inflationary era. So bonds are a great sell. If you have any bonds, if you can short bonds, if you can trade bonds, do it. I know not everyone can do that, but that's certainly what we do. And I would sell every bond that you can out there. Now, the corollary of bonds and of inflation is something that's intuitive, really, which is to buy precious metals. And so I'm a big believer in buying gold and silver at the moment. And The reason that gold's come off a little bit recently is because of this Indian situation, which I think is temporary. The Indians have a love affair with gold, and they can't get their hands on the requisite money to buy the gold that they normally buy. But that will change very quickly. And there's only so much gold in circulation. There's only so much mined every year. And I believe that gold will do very well. So even if it goes down a bit more, I would be a heavy buyer for that. And it's the best protection against inflation known to mankind. And silver equally. And it also has industrial applications. So I'd be a buyer of that. But there's nothing really cheap out there in any markets. And, you know, these slides, by the way, are all available. At the end, there'll be an email address of my colleague, Anthony. You can email him if you want to get copies of it, and you can read them at your leisure. But now I want to move on to, so basically, macro-wise, it's a blah situation. Donald Trump's not too bad a situation, I don't think. We've got a very big problem coming up in Europe. The emerging markets are more or less okay. Markets are finely priced. There's no great value to be had out there, except I would say Japan is on a roll and probably go up much, much higher. And Japanese companies are relatively cheap compared to other developed market companies. But I'm going to give you some very brief rules of engagement that I use when I'm looking at investments. And this comes from long experience and some bitter experience. I don't recommend that people learn by losing money, but if you do lose money, then learn from it. And this is some of the things that I think are really important. And I think the most important thing is to be curious, to look around you, to see what's going on, what other people are doing. Don't just stick with the status quo. Be adaptable. They say that young people coming into the workforce today are going to do about 30 jobs before they're finished. And when you see what I'm going to talk about in terms of longevity, they might be doing 100 jobs because they're going to live even longer than people think at the moment. Application means basically hard work. You can't, go into a rant room, as I call some of the less good tipster sort of sites, and expect to make any money, because first of all, the people who run them don't have any money, and secondly, they are probably just out to benefit themselves. So hard work is absolutely necessary, and specialize in one or two areas because you can't cover everything. And then the network effect, talk to fellow investors. Let's be collaborative about investment. This is not a zero-sum game. We should all be working together to make the money that we need to retire and live the long lives that we expect, because the governments aren't going to do it for you. The insurance companies may not be there in the future, having invested in these stupid bonds. And I'm not sure what this kind of tweeting or twittering that's going on is, but oh, right. Okay. So that was my kind of my group telling me what to do there. Don't invest in the status quo. The status quo equals penury, and look for disruption, comparative advantage, and deep undervaluation. Don't buy things at very high valuations, even if they're fast-growing companies. Look for periods of panic, as I mentioned earlier on. And as far as the future is concerned, okay, my view is that a big idea, it sounds simple and stupid, but sometimes simplicity works, is to find your own big idea, to find one area that you are specialist or semi-specialist in, or know more than most people in. And the big idea can turn into money fountain, all right? So I've changed my career several times, fund management in emerging markets, and then property, and then mining, and latterly biotech, and now I'm really, really interested in one great thing, and it's linked to technology, it's linked to quantum computing, but most importantly, it's linked to the longevity industry. We are the first cohort to live on this planet that recognize that we are cellular beings, that recognize through the sequencing of the human genome that some factors in our cell makeup can be altered by CRISPR technology, as an example, by gene therapy, by drugs, and by fundamentally lifestyle changes, because our process of aging is not dictated. We don't have to die. And there are creatures out there which are semi-immortal because they have certain genomic characteristics that allow them to live beyond what we would consider to be a lifespan. So my new book, which will be out in March next year, is on the business of longevity. It is going to be the biggest business in the world. And I can tell you now that, having visited with some professors in various places, that this is not science fiction. They use 4 models. They use the mice, they use the earthworms, they use the fruit fly, and they use yeast to replicate mutations in DNA, because we have a very common affinity to those creatures in terms of our own DNA, and they have very short life cycles. So if I said to you, I've got an anti-aging drug, I've got a drug that's going to keep you alive for another 50 years, you'd say, well, how are you going to prove it? And that's right, because the trials would go on forever and ever until everyone dropped dead in this room, and hopefully at a much older age. But with these fruit flies and so forth, you can do it really quickly, and you can see what different pathways when altered, can do to longevity. And these researchers are showing 50 to 100% increase in longevity with the with the creatures, the organisms experiencing healthy lifestyle right to the end. They can't work out why they actually die in the end, but they're going to get there. And the combination of quantum computing, which is going to take our computers to a brand new level, with the sequencing of the human genome and this accumulated knowledge. And remember that knowledge once acquired can't be unlearned, and that's why we live in this golden age of opportunity. That's why countries that are devastated by war, like Germany, can regrow very quickly, because they have knowledge even if they have no physical infrastructure. Knowledge is the vital factor in this world. And the internet, which has a lot of bad things going for it, has, more importantly, enabled knowledge to be transmitted around the world between academics, scientists, and so forth. So that our body of information is accumulating at an unprecedented rate. And the ability to read that information with quantum computing and the ability to see through the human genome that we are just cellular beings that are there really to manipulable, basically, encourages me to believe that the first person alive, and I do believe it, to live to 150 is alive today, and possibly older than that, and that we have to rethink the whole of life. So forget about Mr. Trump, Nigel Farage, Marine Le Pen, Theresa May. It doesn't really matter. What really matters is the whole of life is about to be shaken up by the fact that we are now going to move beyond that glass ceiling, which is the 122 years that Jeanne Calment lived until 1998. No one's ever lived longer than that. And we're going to go through that, and then everything, how you have children, how you get educated, what you do for a living, what you do in the long, long period from 65, where people currently retire, to the age of 150, will just have to be thought through. Everything will be upended. It is going to be a huge industry. It's why I'm doing my new book. And I do have on these slides some sort of practical suggestions as to what you might read and what you might invest in, but my time is up, and I've got to go off to the Thanksgiving opening of my pub. It's called Pomona's in Notting Hill, if anyone wants to visit it in the future. And I really appreciate your time tonight, but there are two lessons to be taken away from it. One is that the macroeconomic outlook is always very fluid, but it's particularly fluid at the moment. That provides us with shorter term to medium term opportunities. But number two is that the pace of technological change, which has slowed for a period because computing power hasn't kept up with the requirements of biology, the requirements of the blockchain. There's an interesting blockchain company here called Satoshi Pai. He's somewhere around. You can talk to him later on. He's there in the front. And the requirements of oil and gas industry exploration and so forth. We need stronger computing. That's coming. It's coming very soon. Google's very close to having a true quantum computing computer. And those things mean that we are in a totally golden age of opportunity. And if you are curious, adaptable, and you have a hard work ethic, you have the application, you can make a lot of money. And let's all collaborate on that. And thank you very much, Syndicate Room, for having me tonight.
Thank you. Thank you so much. First and foremost, I promise you that was not the bottle of wine that I was going to give to the gentleman who is not here. I have so much respect for not just what Jim has done, but for anyone who can so seamlessly integrate a financial science and spelling lesson in one presentation. So Jim, thank you very much for that. Thank you.
Thank you very much.
Sorry that he has to dash, but one more time.
Thank you.
So Jim talked a lot about disruption, and obviously at Syndicate Room we pride ourselves on the things that we do in a disruptive way. And in the past year, we've gone from just being a company that operates in the private markets, funding early stage businesses, through the process with the FCA to become a financial intermediary. And our move into the public markets, which started in March, has recently taken another step forward with the launch of a new product. And for those of you who haven't heard about it, my colleague Tom Hinton, who's going to join me on the stage in a second. He's going to explain it a little bit. So Tom, well done.
Thank you.
Yeah. Good graduate.
Yes, I know Frank.
My name's Tom Hinton. I'm head of capital markets at Syndicate Room. I've been here probably 18 months now, and 18 months ago I didn't expect Jim Mellon to be my warm-up act, but there you go. So how life changes. He assures me he's watching me in the cab on the way to his pub on YouTube, but I don't know if that's going to happen. So we launched the watch list probably a week ago. And I'm sure you've all been reading up on it before this presentation. But Jim touched on a couple of things earlier, which I think are important. And one is where are you going to find the returns? And he mentioned early stage AIM companies. And I promise I didn't tell him to say that. But when we were entering into the public markets, we realized that retail investors and Syndicate Room members weren't getting access to primary capital raises on the London Stock Exchange. So there have been £4 billion worth of primary capital raised in London this year, and only a fraction of that has been offered to retail investors. And we thought, why is that? And there are a number of reasons. Part of it is inside information, part of it is regulation, part of it is just the way that things are done. And it particularly prescient in the lower small cap AIM space in placings. So we all put our heads together and we came up with the watch list. And the watch list aims to give retail investors access to primary capital raises of already publicly listed companies and to give publicly listed companies access to differentiated demand. So how does it work? So it's very simple. We list a company on the watch list on the basis of publicly available information. We ask all our members, which all of you are members, to express their interest, binding interest, on the basis of this publicly available information. And then we pool all that capital in one pot. And we communicate that to the company. And then that company is able to take that demand or in one tranche or take it as a broader placing. And all of our investors are able to invest on the same terms as institutional investors. So why do we think this is a good product? The reason is, as Jim said, that AIM companies share a lot of the characteristics that our early stage businesses show. So the businesses you can invest in on Syndicate Room on the private side. So they're early stage, they've got potential for extremely high growth. They're often in very interesting markets. They've got dynamic management teams, but they're significantly de-risked. And they're de-risked because they're publicly listed, they've got reporting requirements, they've got corporate governance, and there's liquidity in the stock, which you just don't have on the private side. So in addition to that, we have, as on the private side again, we've teamed up with expert professional investors to actually find the companies for you. And again, Jim mentioned it in his address, and he said, how are you going to find the time, if you have the time, as a private investor, to mull over 1,000 companies on AIM and find the winners, go ahead. But how is anyone actually reasonable, who's got a job and all the rest of it, going to do that? So we teamed up with some really credible, very experienced professional investors to unearth these opportunities for us. So what our watchers do, I think some of them are here tonight. I don't know if Charles Breeze or Chris Boxall are here, but have to have a huge thank you to them. But what they do is they unearth these companies, they publish their investment criteria, and they explain why they want to invest in them. And our members get to leverage off that experience and invest in the same companies. So I thought it was worth thinking about the company. What's in it for the company? So the best way, I don't know how familiar you are with the fundraising process on a publicly listed company, but I thought obviously all of you have classic cars, and you go out there and you probably at some point want to monetize your classic car, and you go to the dealer and you say, how do I sell my classic car? And he says, well, don't worry about it, leave it to me. What I'm going to do is I'll take you around, I'll spin you around all my friends, and it's going to cost a bit of commission, but that's fine because it's going to be great fun, and take you 2 to 3 weeks, and we'll drive around, And you think, okay, that sounds great, we'll sell the car. So you pop in the passenger seat, he drives you around, you meet all these potential buyers. They look under the bonnet and they think, yeah, it's very interesting, you get some good feedback. You go home, you realize the bills have piled up at home, there's dust all over the house, you've been away for 3 weeks, haven't managed to check your emails. And then you get a call from the salesperson. He says, you know, it was really good, great feedback. They love the classic car, but it turns out they wanted to buy a Mondeo. And you say, well, you know, that was a bit of a waste of time. Shouldn't I have just, you know, put it on Exchange and Mart? And he says, yeah, but don't worry. They really want to buy it, but they'll buy it at a 30 to 50% discount. To which you say, well, that's great. My brother, who owns half the car, isn't going to be that happy about it. And that may sound like a frivolous story, but it's actually the experience when we've been speaking to companies that they come to. You know, these management teams run around meeting institutional investors, but they're not exposed to the whole market. So, you know, that's what we've done. We've given these companies access to a differentiated pool of investors, which is potentially extremely valuable to them. We've cut their costs, we've saved them time, and we've helped them with their publicity. And I think that's a really, really important thing, that we've given access to retail investors, to really exciting high-growth companies, and to high-growth companies to access to retail investors when they do a primary capital raise. So we launched this product last week. We got a hell of a lot of positive feedback and questions from some of you, I'm sure, who are in the room. But almost one of the most, I guess, appealing responses I got was from a couple of brokers who called up complaining or whinging about the product, I should say. And it reminded me of poor old King Canute, who was standing on that shoreline one day, and he probably said, even a king can't hold back the tide. So that's all I've got to say, and if there are any questions. Save them till later. Cheers.
So just before we get to the question, actually, continuing with the theme of innovation and breakthrough products that Syndicate Rooms have been working on this year, we went through another process with the FCA, our best friends, to become an alternative investment fund manager. We saw a demand in the market for it, and because he's here tonight, our Chief Investment Officer, James Soar, is going to take us through the fund as soon as he stops whispering sweet nothings into the technician's ear. James, please, come on up.
Cheers. Hello, everybody. I'm James Soar, the Chief Investment Officer of Syndicate Room. I've been with them since May 2014. So there was some of us around. There was a co-founder and Fran. We were in a very small office space, rented, and it was a very different place than it is now, and it's been an amazing experience for me to see it grow. So I'm going to talk to you a little bit about another product that we technically launched in June, and we've just launched on the platform as of a few days ago. So we all know that early stage investing is difficult. If it was easy, everybody would be very rich and everybody could have Aston Martins. It's a difficult thing, and there's a lot of advice around, you know, how you get into it and how you find the investments and how you select those investments and price them and so on and so forth. One of the common themes is know your sector. And one of the reasons that we built Syndicate Room was that it's sometimes difficult for private investors to get access and time to find all these investments and to do all the due diligence needed to invest. And so Syndicate Room, with its investor-led model, allows people to kind of leverage the experience and knowledge and time and effort and due diligence that's been done by the lead investors to invest in alongside them. So knowing your sector is one thing, and Syndicate Room has built a very successful platform in allowing investors access in that space. But they also say you need to diversify your portfolio. Now, it's the old adage, there's no such thing as a free lunch. Harry Markowitz, the Nobel Prize-winning economist, is famed for saying that diversification is the only free lunch in finance. And what he means is that if you're able to spread your investments over a number of portfolio companies, you're able to diversify your portfolio and therefore spread your risk. But unfortunately, it's very difficult, because how do you diversify without knowing your sector? And so we were looking at Syndicate Room and felt, okay, well, is there an opportunity here for people that don't want to just stock pick effectively? They don't want to pick their own investments directly. And we all know that there's an appetite for various different products such as funds. So we thought, well, what type of funds are available in the space? So we looked at EIS funds, and SEIS is not particularly a space that we work in, but we have a few of them. But we felt, okay, predominantly our investor base is looking at EIS. So on a review of the existing fund market, we found a very common theme. They too struggle from the same problem. They need to know their sector. And so what it means is that most EIS funds are single sector offerings. So when you invest, you might get a biotech one, you might get a pub one, in theme of Jim, storage, and all sorts of different products that are very single sector specific. And because they generally are quite small funds, they generally have low assets under management, and therefore, because of the way that they're funded through the annual management charge, they generally have quite a small team. So generally they're single sector, and also they have a very small number of investments within that portfolio because they don't have a very large team to review thousands and thousands of different investment opportunities. So we looked and felt, okay, well, what type of offerings we've got? We've got single investments, which we think we're doing very well at. And then you've got the option to go into a fund, and unfortunately you then undo a lot of the investment sort of appetite, or investment behaviors that would be single sector and very small number of investments. So we could, okay, well, let's look further up the market. We're always aspirational as a business, and we're always looking to try and learn from the good things that the major players do within the market further up in the main market. What do they do? ETFs is one of the sort of passive products and very, very explosive products that has happened over the last 3 or 4 years. They've got huge share at the moment because they're very simple, they're very low cost base, and they give large diversification over a large number of investments. So we thought, okay, well, can we do a passive product? Is any passive product in the early stage space? And we looked, and there wasn't. There's pretty much nothing that really looks at diversification. And we felt, well, there was a big gap here. So we created Fund 28. Fund 28 is the first passive investment, or smart beta, depending on how you want to define it. So we felt, okay, well, how can we deploy capital? So we can do, it's not a particularly polite way, but we can do spray and pray. We'll raise capital and put 100K into every single investment opportunity that comes onto the platform. Well, what does that do? Well, smart beta is about doing different weightings and different ways to allocate money over different investments. And so we felt, okay, is there a way for us to define how much money to go into each deal? And so we said, well, we've got this great opportunity here. We have all of these lead investors who've gone out, spent their time, effort, money, finding these investment opportunities, pricing, structuring. And then we've got all of our investors online, high net worth and sophisticated investors and above. They are making their own investment decisions from £1,000 upwards, but they're having to put their money down to make that investment decision. So we said, well, why don't we use this investment appetite, not this sentiment of a fund manager, to deploy the capital? And so Fund 28 uses the investment appetite of our network to define how much capital comes out into the fund. It's the first time that this has been done in the space, and we felt, well, okay, well, in terms of how big a portfolio do we need, what's an acceptable amount? Angel investors generally have this sort of 30 number in their head, and so we thought, is there something a bit more concrete than the opinions of angel investors just sort of generally talking? And so we looked for some research, and actually there's some research by Nesta, an Intelligent Partnership, that looked at if you wanted to get a diversified portfolio, you need there's a 95% chance of, with a 95% chance of securing at least one 10x investment or more within the portfolio. They came up with a calculation of about 28.3, I think it is. And so it all fits within the same number, and don't get too much hooked up about the exact number of investments in the portfolio. But what you can see is that we've developed a product that is markedly different from the options you get within the existing space. So you have single sector, 5 to 8 investments per fund, or multi-sector exposure with a large number of investments of 28 plus. And so that's why we developed Fund 28, and that's why we're really excited to see how that grows over the platform and how that helps accelerate some of the businesses within there.
Yeah. So now we'll do Q&A with both James and Tom. So if Tom, you'll join me. And who's handing the mics out? If anyone has a question for either of them, please raise your hand. There's a gentleman there. I'll bring it to you. Oh, sorry. Can you take it?
Hi, good evening. I had a question for Fund 28. I think it's a fantastic idea. Can you share with us a little bit sort of your thinking behind the fee structure?
Yep.
And in how far sort of the performance element of that is somewhat, in balance with your idea of a purely passive fund?
Yeah. So main market funds, take an ETF or something, they might be running at 0.46% maybe annual management charge, something like that, running on a couple of billion assets under management. We're running at 1% annual management charge. There's a 1% initial charge. Market is running at about, calculations are about 2.5% to 3.5%, something like that. Some of them are a lot higher than that as well, because you get transaction charges and all sorts of things. So we're well below half of market. We have a hurdle of 110%, meaning that, and that's of subscribed money. So if you put 100K in, you would need 110 grand to be returned to you before performance comes in. And yes, we have a performance fee. Partially that's to subsidize the fact that we're able to keep the costs, trying to keep the costs as low as possible, and also to align a reward for us and the platform for delivering a service that hopefully is in line with the investors. Performance fees are probably one of the most argued fee structures about. I mean, funds have to try and align the incentives so that the fund managers do the job, or the service there for the investor is delivering what the investor wants. If there's an argument some people argue that no performance fees, and yes, in the main markets they're able to do zero performance fees on massive ETFs. Obviously, the amount of money they're running is a lot larger. Some people also argue that if you take the performance fee out, the platform doesn't really care what happens, as long as its AUM keeps increasing and it's able to keep inflows, they're happy. We're not happy. What we want and what we've built from day one, and why we were originally in equity crowdfunding this sort of term, and how from day one we've just never aligned ourselves with that industry because of this investor-led approach, is that we want investors to make money. And therefore, we want to align our incentive fee appropriately.
I don't have a mic, but raise your hand if you have another question.
Yeah, chap at the front.
How will Fund 28 decide how to exit an investment?
So the exits are generally traditional IPOs, trade sales, etc. Predominantly, it will be following what's the decision of the business. Most of the stakes are minority stakes within the, very minority, as in sub sort of 5%. So it's the vote of those is not actually going to affect whether the certain decision is made anyway. But generally, it will be following on from what the lead investors' decisions are. The fund manager, it's myself, we would still have full control as to whether we wish to vote or not. And we have the option to actually reach out to investors as well, and take a majority vote. But predominantly, it's decided by the fund manager, and predominantly it will be following what the business is doing via the lead investor. Because in the same way with Syndicate Room, the fund is taking the same share class, normally associated rights. If the share class is coming in from a VC or someone, they might have a different one because of liquidation preferences and so on and so forth. But generally what happens is you're trying to align yourselves with the same, again, incentive model of that investor. So if it's good for them to exit, ostensibly it should be good for us.
With regards to access to deal flow, are the deals that Fund 28 invest in, are they exclusive to Syndicate Room, or will you look at businesses, private deals outside of?
So we will only invest on EIS opportunities that are on the platform. The reason for doing that is that it's the safest way for us to feel comfortable that it fits within our investment strategy. And secondly, it takes away the need for me to be an active manager. It's really appealing. Like, it's really appealing for me to go, oh, wouldn't it be great if I raised raise some funds and I make the decisions and so on and so forth. It's not the limitations of having an active manager. We felt outweigh us having this passive ability, and having this passive, large portfolio, multi-sector exposure. We think gives a better chance for investors to get a reasonable return. Yes, the barnstormers the returns from the really, really big flyaway companies get muted because they're a smaller percentage within the overall portfolio. But we felt overall that having this passive ability was the important factor. And for us to do that, we need to take away the active decision, which means we need them to all be on the platform to make sure they adhere to all the rules and tests and checks that we do.
Hi, is there a maximum percentage of the overall raise that you would take? Because I know you're looking to be 90% invested over a 12-month period, which implies you have to make 28 investments.
Minimum, yeah.
There've got to be quite a few raises on the platform. Could you take 100% for a raise on Syndicate Room's platform, or are you?
Could the fund?
Yeah.
So the fund's limited to the maximum investment in a single investment from the fund is 1/28th. So that guaranteed you will get 28 or more. So take the full fund. So take the full fund size that we close within the investment fund, within Fund 28. That will not deploy more than 1/28th of that total fundraise into a single investment.
Okay, yeah, that I understand. But if there's a fundraise of 500,000,
Yeah.
and you've got 100 million, you could take the entire, you could take that entire raise.
Correct. If sufficient money came, if sufficient money came from the underlying investments. So we have what we do is when the fund is closed, we know how much is in the fund, and then we do a proportion. So we work out how much money for, say, £1,000 turning it from an investor online, how much would come from the fund. And that's what sets how much actually goes out. So, but all of the time, the only way that money can come out of the fund is if our investor base is putting their own money down. So there's no way for the fund to, for me to just feel really, really happy one day and just move a load of money, or very unhappy and pull a load of money back out.
Hi guys, sorry, just to cut it off for one quick second. We're going to kind of wrap it up, but for those who have questions, stick around afterwards and come down and talk to them. There is a session outside for networking, for meeting some of the companies, for meeting some of your other investors. So I encourage you to, if you don't have a question about Fund 28 or the watch list, please do go out there, have drinks, talk to people, meet the companies and meet the people. And lastly, obviously, thank you to all of those who have stuck around and who have supported the cause tonight. Thank you to Jim, thank you to all of our sponsors, thank you to James and Tom. We couldn't do this and we wouldn't do this if we didn't have such support from yourselves. So thank you for that. Please. There is a fund brochure, there's a watch list brochure, and there's this disclaimer up here, which I will try and read through.
Everybody's read, right?
Yeah, which you've all read, right? You can read that from back there. So if you do have questions, please stick around. James and Tom will both be here, and come down and talk to them, listen to what your other investors have to say. And if not, thank you again, and have a lovely evening. Cheers. How are you doing? Very well. Good to see you. Sorry. Thank you for coming.
My pleasure. It was very good.
Yeah.
Very, very good.
I think we try to keep it to an hour because after about an hour, people start to come back. Thank you so much, Michael.
No worries.